then of course there's nothing to worry about. But by the nature of TFI money, there is an uncertainty. It can depend on what their perception is about the returns from India. It can also depend on their perception of returns elsewhere. So even if they find nothing wrong in India, if suddenly they find a more profitable opportunity in Brazil, and you have your funds here, you would like to sell in India and go there, but that can disturb the Indian economy. So that is our concern, and whether you look at the financial stability report of the RBI, or you look at the last meeting of the Financial Stability Development Council, FSDC, I think it is called, which is a coordinating agency. So you have the Finance Ministry, the RBI, SEBI, the insurance regulator. They are all in one place. Earlier, the problem was that even when you had regulators, they were all scattered. SEBI would look after the capital markets, and RBI would look after local currency and foreign currency and things like that. The Finance Ministry would look after something else, banks and other things. There was not much of coordination between them. So this council was set up to have a coordination, and their last meeting there was concern about the current account deficit being large. So in that context, you have a problem. Foreign exchange reserves, as I mentioned on an earlier occasion, foreign exchange reserves with the RBI now as a fraction of GDP are not large. It is 6, 7, 8 months of imports. They're about some 5, 6 years ago, they used to be a lot more substantial. What has happened in the meanwhile is that the economy has grown, the nominal GDP has gone up, but the reserves haven't gone up, they've been somewhat stagnant. So in relative terms, they have fallen. So in that context, credit lines, or for that matter, even capital controls, are a policy requirement. Now, that was to link the Indian situation with our discussion of theory on credit lines. But linking the current account deficit with gold, one reason why the current account deficit is large is the large imports of gold in the last few years. And some have argued that if you were to remove this one item of large gold imports, then that can make some difference to the current account deficit. And it is in this context that twice the Finance Ministry has imposed a tax on gold imports. It was done once by the previous Finance Minister, and then it was redone again. The tax rate has been increased. That is to deal with the short-run problem of gold imports, and that is in the context of the current account deficit. Of course, we have a long-run problem, which is that there is too much gold. In foreign investors in India, households gold holding massive savings in the Indian banking sector. What is interesting and, if I may say, also disturbing, is that the RBI itself has purchased 200 tons of gold from the IMF. So you have about 32,000 crores being spent by the RBI itself. It was interesting. There was a seminar at Great Lakes Institute of Management in Chennai, and in one session, the RBI Deputy Governor through his speech advised the public not to buy so much gold. It's unproductive, it's useless. That was an important message in the first session of the conference there. After tea break in the second session, then there were other officials of RBI who kept complimenting their organization and saying that, RBI has done a wonderful thing by buying gold. And they also said that following RBI's purchase of gold, Bangladesh and some other countries, I think Mauritius, I forget the other name, but some other central banks also bought gold in the market, international market. And it was as if India was leading. Now, of course, it's good to lead, but it's good to lead where you're doing a good thing. Now, here is a bit of a debatable issue, whether it is good at all on the part of RBI to buy look at this chart here. It shows the various uses of gold, and this red bar is the investment part. And you can see that the investment component has been increasing. You call it investment or you call it speculative. So this is the asset demand that is there in the market. So earlier you would have people buying shares and people buying bonds, bank deposits, but in the last few years, and this is not even updated, it's up to 2009, you can see a lot of this is being investment or being an inventory, possibly a transitory inventory. In this case, there is worry about gold price volatility in future.
But the same graph, if you look at the gold production, that may not have gone up, or means
it hasn't.
So it means somebody is selling and some people are buying. It's a transfer of gold from one location to another location.
Yeah, so one kind of buyer is the RBI, and the seller was the IMF. In earlier years, it was European central banks which were selling gold, and then it is ordinary consumers in India buying. So in the last few years, the gold price has risen much, and in fact, some of the RBI officials also said that since the time that we have purchased gold, the gold price has gone up, and RBI has made a profit on the gold purchase. That is true in the short term, but if you look at the long-term trend of prices of assets, this is 1802. It's missing out there, but let me tell you, it's there at the top, so fine. So it is from 1802 to 2006. So this is covering about 200 years. And that's an important history to go by. Of course, the familiar thing that stocks doing very well, but what we are concerned with here is gold. Look at the price of gold. For a long period of time, it is stagnant. Then you have this rise, but notice even when you do have this rise, this is the consumer price index. So much of the rise is to keep pace with the general inflation in the economy. So if everything else price going up, the gold price also goes up. So it is more, but it is not substantially more. And another thing is that the so-called stability or safety of gold, look at the chart here. It rose dramatically, then it has also fallen. So gold can also be a volatile asset. This will become a little clearer in this chart. That was nominal values, this is real values after adjusting for inflation. And it's only this last phase. This is also not up to date, so it will show some more rise. But in the long run context, long run here meaning 200 years, 210 years or so, then you will have a slight increase in the price of gold, a very slight increase. The public attention The media attention is only on this recent past. So it's not as rosy a picture as one would like to believe, going by the previous history. Now, of course, some argue that, well, things have changed. Gold was not important in the past, but it is going to become more important in the future. So the price of gold will continue to rise, and it will continue to show the kind of appreciation it has in the last few years. Hard to judge that part. But theoretically, let us be clear about the role of gold. Gold is the international monetary system. As I mentioned, IMF has sold gold in recent years. Can central banks do the same? European central banks have been doing that over time gradually. They agreed to do this gradually so that there is not a crash in the price of gold, which would hurt them also. So it was done in a phased manner. Now, gold plays two roles in the international monetary system. IMF is for international monetary system till 1971. Money was linked to gold. These are two distinct roles of gold. Money supply being linked to gold. Earlier it was gold standard. So how much was the base money or high-powered money in the economy? That was the monetary gold in the economy. But that was there only till 1971. After 1971, the monetary system is completely, and I repeat, completely delinked from gold. It has nothing to do with the amount of gold with the central bank or with the economy. But gold has another role, which is that it's an important asset in central bank's portfolio. So you have foreign exchange reserves, you have government bonds, and you have gold, the three main assets. And gold is increasingly smaller and smaller fraction on the asset side of the balance sheet of the central bank. But that's a portfolio choice. Just as we have a portfolio choice, I may invest my money in stocks, I may invest my money in gold. Similarly, the RBI may invest its money in government bonds or foreign exchange reserves, or it may invest in gold. That's a portfolio choice. So the second role of gold is still present. The first one isn't. So now the main thing is money and gold linkage, which is not there at all. So it's just that this role of gold, the portfolio choice, that is not crucial to central banking. You have alternative assets. So it's in that context that it's possible for central banks to consider sale of gold and pass on revenues to governments which have large debt. Central banks in emerging economies too can